Welcome to Tech Money Madness, your daily U.S. stock market podcast. Today is August 28, 2026. Right now, the market is trapped in a massive contradiction.
Yeah, contradiction is definitely the word for it today.
I mean, we've got this AI technology that is supposed to make everything cheaper, right? But it's currently so expensive to build that it might just force the Federal Reserve to hike interest rates.
Exactly. And that's the paradox we're digging into.
Right, so our mission for this deep dive is to unpack an absolute mountain of market reports to figure out why the market suddenly and quite aggressively reversed course today. We are watching this high-speed collision between skyrocketing tech investments and a remarkably stubborn Fed.
It really is a fascinating setup when you look at the mechanics behind today's market action. I mean, we're seeing cooling baseline economic data violently clashing with this really hawkish central bank sentiment.
Yeah, it's wild.
And beneath the surface of all that, you have AI's promise of a deflationary future, actively battling against the very real, very inflationary reality of, actually building out that technology today.
So let's unpack this by starting with a direct catalyst for today's drop. We're calling it the Jackson Hole hangover.
That's a good name for it.
Right. The closing numbers tell quite a story for anyone watching their portfolio today. U.S. stocks closed lower, completely reversing the gains we saw earlier in the session.
Yeah, they really gave it all back.
The S&P 500 fell 0.13%, the Nasdaq dropped 0.30%, and the real pain, the serious damage, was in growth and semiconductors. The SOXX ETF took an absolute beating, falling 3.14%.
It was ugly.
And the trigger for this was a major policy speech in Wyoming by Fed Chair Kevin Warsh that seriously spooked investors. It was basically like a chaperone walking into a high school party and just, aggressively flicking on the bright lights.
That is a very accurate way to describe Warsh's tone. He used that Jackson Hole address to outline a philosophy of, cautious hawkishness. He avoided giving specific forward guidance on rates, but he firmly emphasized that inflation is still the central concern.
Which the market hated.
Yeah, because the implicit message there was that rate cuts in 2026 are highly unlikely. Meanwhile, rate hikes, they're very much still on the table.
And the market absorbed that reality check instantly. Looking at the futures market, you see it pricing in roughly a 50% chance of a September rate hike now.
Which is a massive shift.
A huge shift. Just a few weeks ago, nobody was thinking about a hike. We also saw the 2-year Treasury yield jump significantly today.
And the break-even inflation rate hit a 2-month high.
Yeah. Plus, we have these new comments from Fed official Hammack, who is urgently calling for immediate rate action. Hammack is basically arguing that persistent inflation is just putting way too much strain on household budgets.
Right. The idea being that the pain for everyday consumers is now outweighing the risk of slowing down the corporate sector.
But I want to push back on the underlying premise here, for you and for the listeners. If the Fed is so eager to hike rates to choke off this borrowing, is the actual on-the-ground data really demanding it?
Well, it depends on which data you look at.
Let us walk through the latest inflation numbers, because to me, they read like a mixed bag.
They definitely do.
Core PCE, which, is the Fed's preferred inflation gauge, that came in at 3.3% annually for July. That is actually below the 3.6% forecast. And CPI held steady at 3.4% year over year. And wholesale prices, the PPI was completely flat in July. It totally missed the expected 0.2% gain.
Right.
So we have flat wholesale prices and a miss on core inflation. Why is the market panicking about a rate hike?
The panic stems from this tug-of-war between backward-looking data and forward-looking sentiment. The PCE, CPI, PTI, those tell us what happened a month ago.
Right, they're in the rearview mirror.
Exactly. They are cooling, sure. But the market isn't trading on what happened last month. It's trading on what it costs to do business tomorrow. Today, that break-even inflation rate hit its highest level in over 2 months.
And let's quickly define what we mean by the break-even inflation rate, just because it's a crucial mechanism for this deep dive.
Good idea.
It's essentially the market putting its money where its mouth is regarding future inflation. It's the difference in yield between a standard nominal Treasury bond and a TIPS, a Treasury inflation-protected security.
Right.
So when that gap widens, like today, hitting a 2-month high, it means bond traders are literally betting millions of dollars that inflation is going to be sticky and stay elevated.
Yeah, regardless of what last month's CPI print said. And, we can't ignore the political dimension here either.
Oh, definitely. President Trump was out again today criticizing the Fed policy.
All right.
He claimed the U.S. should be paying, quote, much less in interest, and he accused officials of having political motivations. We're just neutrally reporting this, but it's a stark reminder of how high the stakes are when central bank policy starts squeezing the broader economy.
Absolutely. But as analysts, we have to look past the political noise. We have to focus on the math pricing into the assets you actually hold.
Right, the actual numbers.
Yeah. Regardless of political pressure or even a cooling, backward-looking PCE print, the reality is a 50-50 coin toss for a September rate hike. The market just does not believe the cooling trend is durable.
So let's explore exactly why they don't think it's durable. If we connect the Fed inflation fears directly to the market's absolute favorite sector right now, big tech, we uncover this massive irony.
The AI irony.
Exactly. Tech leaders have been arguing for years that AI will eventually drive down costs across the entire economy.
Right.
It'll make coding cheaper, logistics more efficient, automate customer service.
It's supposed to be the ultimate deflationary tool.
Yes. But the current reality, it's slow corporate adoption paired with absolutely gargantuan capital expenditure to build out these data centers.
Yeah, the CapEx is just staggering. Every new AI data center requires enormous amounts of energy. It requires massive physical construction. We're talking concrete, steel, copper.
Tons of copper.
Right, and billions in specialized hardware and cooling systems. All of those massive costs are feeding directly into the physical economy right now.
It's like buying a ridiculously expensive, energy-guzzling smart home system because you think it will eventually save you money on your electric bill.
That's a great way to put it.
The theory makes sense, but the upfront cost is absolutely draining your wallet today. These tech companies are buying up all the available copper, they are overwhelming local power grids, and they are competing for specialized construction labor.
And they are doing all of this right at the exact moment the Federal Reserve is desperately trying to cool the economy down.
It's totally counterproductive to the Fed's goals.
It is. This physical constraint is fundamentally reinforcing the Fed's hawkish stance. It makes it incredibly difficult for Kevin Warsh to even consider cutting rates, even if broader economic growth starts to slow.
Because the tech sector is basically building a massive inflationary engine to eventually create a deflationary software product.
Exactly. But right now, we are just feeling the intense heat from the engine.
So tech companies are scrambling to finance these expensive data centers in a high-rate environment, and it is actively splitting the market into winners and losers.
We saw that very clearly today.
I did. To see how this heavy CapEx environment is playing out, let's look at a tale of two tech giants, Nvidia and Apple. They had wildly different reactions to the exact same macro data.
Because they represent entirely different ends of the AI spectrum.
Let's start with Nvidia. They just posted another absolute blowout quarter. Earnings were stellar.
Oh yeah, huge numbers.
Jim Cramer was on the air telling people to, quote, own it, do not trade it. And initially, the stock surged 8.4% on those earnings.
But then Warsh spoke.
Right. As the reality of Warsh's hawkish speech set in, Nvidia gave back every single cent of those gains and closed down 4.46% today.
That is some brutal whiplash.
It really is. And I have a theory on this. Nvidia sells the shovels for the AI gold rush, but those shovels are so expensive they have to be financed with debt. If the Fed keeps rates high, the borrowing costs for Nvidia's customers stay astronomical.
Right, and eventually the market realizes those customers can't just keep financing multi-billion-dollar build-outs forever.
Exactly.
And your theory tracks perfectly with the mechanics of valuation. When you buy Nvidia, you are paying a massive premium for future growth.
Right. Richly valued growth names are vulnerable.
Highly vulnerable. In financial modeling, you discount future cash flows back to the present using an interest rate. So when the expectation for interest rates rises like it did today, the mathematical present value of that future growth just drops instantly.
Now, contrast that with Apple. Apple completely bucked the market trend today. While semiconductors were getting hammered, Apple actually rose 1.60%.
They had some pretty massive news driving that.
They did. Under their new CEO, John Ternus, Apple announced a September 9 event to unveil the iPhone 18 family.
People are very hyped for this.
Oh, absolutely.
Yeah.
We're talking the new A20 Pro and C2 chips, vastly enhanced Apple intelligence capabilities, and upgraded Siri.
And the rumors of their first foldable iPhone.
Yes. Priced above $2,000, which is wild. Plus, they announced major price hikes for their Apple TV and Apple One services. Investors clearly love it.
Well, the key distinction here is the how of their AI strategy. Apple focuses heavily on on-device processing.
Right.
They want the AI running locally on the phone in your hand rather than in the cloud.
And from a purely financial mechanics standpoint, that strategy is genius in a high-rate environment. By keeping the processing on the device, Apple doesn't have to build nearly as many $10 billion power-hungry cloud data centers.
Yeah, they essentially outsource the hardware and electricity costs directly to the consumer.
Exactly. You buy the expensive phone, you charge it at your house, and Apple completely avoids the massive corporate debt required to build cloud infrastructure. It protects their margins beautifully when the Fed is threatening to hike rates.
Which completely explains their resilience today. I mean, Apple is a services-heavy, cash-generative company. They are up 15% year-to-date with an incredible 90% customer retention rate.
90%. That's insane.
That's unheard of. They don't need to borrow billions. They just raise the price on your monthly Apple One subscription. And with that retention rate, they know you're going to pay it.
Right. It generates immediate, reliable cash flow.
Which means they carry a vastly different risk profile compared to a semiconductor company that relies on, massive debt-fueled corporate spending.
But tech companies aren't the only ones competing for capital in this high-rate environment. They are bidding against a U.S. government that just hit a terrifying math problem of its own.
The $40 trillion elephant in the room.
Exactly. And this impacts every single investor listening to this deep dive, from the mortgage rate on your house to the discount rate on your 401k. I'll drop the headline numbers for you, and they are staggering.
Brace yourselves.
U.S. government debt just officially surpassed $40 trillion for the first time. The national debt has more than doubled in just the past decade.
It's an astronomical figure.
It is. The budget deficit surged in July to its highest level since March 2021. Cumulative deficit spending has hit nearly $1.8 trillion over just the first 10 months of the fiscal year.
Yeah.
So my question for you is, can the Treasury just step in and manipulate its own debt market to keep yields manageable? I mean, we saw Treasury Secretary Scott Bessent announce a bond buyback operation exceeding $4 billion recently.
Right, and there are rumors they might tap the $1 trillion Treasury general account next.
Exactly. So can they just engineer their way out of this?
Well, let's break down the mechanics of those interventions, because the broader market is deeply skeptical that they'll actually work.
Why?
When the Treasury executes a bond buyback, they are basically purchasing older, less liquid bonds to try and inject cash into the system. The goal is to artificially lower the yield curve.
And tapping the Treasury general account does something similar.
Yeah, the TGA is basically the government's checking account at the Fed. Tapping it flushes liquidity into the financial system.
So wait, the Treasury is trying to lower yields and inject liquidity, while the Federal Reserve is actively keeping rates high and pulling liquidity out of the system.
Exactly.
That's like taking out a new high-interest credit card to pay off your old credit card, while the bank is actively raising your limit and charging you more.
It's a perfect analogy. It's a temporary liquidity trick, not a structural fix. And that is precisely why prominent billionaires like Stanley Druckenmiller are publicly voicing serious doubts about these bond market ploys.
Right. Druckenmiller has been very vocal about this.
Because the Treasury is fighting against massive opposing macro headwinds. So far, these interventions have only generated very modest yield declines. Secretary Bessent is out there claiming there is a, quote, very good chance the deficit has peaked.
But the market isn't buying it.
Not at all. Because the math just doesn't support it yet, this structural debt issue is going to linger, regardless of what the Fed or the Treasury tries to do in the short term.
So what does this all mean for you, the listener? Zooming out, how does structural debt, rate uncertainty, and this massive tech divergence affect the actual vehicles you invest in?
Let's get into the ETF mechanics.
Yeah, let's talk ETF strategy. A lot of analysts are flagging Invesco's QQQM as the top single ETF choice for 2026.
It's been incredibly popular.
Oh yeah. It tracks the Nasdaq 100, it has a super low 0.15% expense ratio, and it posts an incredible 98% total return over the last 5 years.
Which is fantastic, but there is a major catch.
Concentration risk, right.
Exactly. The critical warning for anyone holding QQQM is understanding how it interacts with the rest of your portfolio.
Right, because it's so heavy on the AI giants, Nvidia, Apple, Microsoft.
Yeah, and if you hold QQQM alongside a standard S&P 500 ETF like VOO, you have massive portfolio overlap. The tech giants absolutely dominate the market cap of the S&P 500 right now.
So you think you're diversified, but you're really not.
Right. Combining those two funds could result in you unknowingly allocating half of your entire net worth to just the technology sector.
Yikes.
And if rates stay high and borrowing costs choke off those data center bills and growth gets hit like we saw today, You have absolutely nowhere to hide.
Which brings up a valuation metric that genuinely gave me pause today while looking at the reports. The S&P 500's CAPE ratio is currently at its highest level in 26 years.
The dot-com bubble level.
Yes. For those unfamiliar, CAPE stands for Cyclically Adjusted Price-to-Earnings Ratio. Unlike a standard PE ratio that just looks at 1 year, CAPE smooths out earnings over 10 years to adjust for economic cycles. And the last time it was this high, we were at the absolute peak of the 90s tech bubble.
It's a scary comparison.
It is. Furthermore, GF value metrics suggest the SPY ETF is roughly 7.5% overvalued right now. So I have to ask, are we partying like it's 1999?
It's a valid fear. I mean, it really is. But let's look at the mechanics of those earnings to provide a somewhat reassuring counterweight.
Please do.
The 1990s were characterized by speculative companies with zero revenue, no real business model, and just a .com slapped on their name.
Right, pets.com and all that.
Exactly. Today's AI giants have massive, real cash flows. I mean, we just talked about it. When Apple raises the price of Apple TV, millions of people just pay it.
Very true.
They have incredibly durable competitive advantages. So yes, the market is historically expensive. Yes, SPY looks overvalued on paper, but the underlying quality of the earnings supporting that valuation is just vastly superior to the speculation we saw 26 years ago.
Okay, that makes sense. Now, before we wrap up, we need to do a quick global lightning round, because all of these U.S. dynamics are sending shockwaves overseas.
Right. It's a heavily interconnected market.
So just weaving these in quickly, Canada-U.S. trade tensions are escalating, which is sliding the Canadian dollar downward.
Meanwhile, China is actively building alternative financial infrastructure, specifically the CIPS system, to hedge against U.S. sanction powers.
Which ties right back into them seeing our $40 trillion debt load. Also in Asia, Singapore's inflation surprisingly undershot expectations, coming in at 2.2%.
But over in Europe, the UK economy is facing serious headwinds from the fallout of the Iran conflict.
And finally, Russia just fired economist Andrei Klepak after he warned that the country couldn't sustain prolonged war costs.
Showing that sovereign debt and spending limits eventually catch up to everyone.
Exactly. So to synthesize the major takeaways from today's deep dive, we are looking at 5 key themes dictating the market's direction. Number 1, the hawkish Fed is dominating the narrative. With Warsh and Hammock pushing back, the odds of a September rate hike have surged to roughly 50%.
Number 2, inflation is acting incredibly sticky in forward-looking sentiment. Despite some cooling in backward data, bond markets expect prices to stay elevated.
Number 3, the market is highly skeptical of the Treasury's ability to intervene. Buybacks and liquidity injections are just meeting too much resistance.
Number 4, the AI investment boom is a double-edged sword. It's driving growth, but the physical footprint required for data centers is severely complicating the inflation fight.
And number 5, the historic $40 trillion debt load poses a lingering, long-term structural risk.
Ultimately, the forward look from here is cautious. The market is at historically elevated valuations, and rate uncertainty is high. As long as rate hike expectations persist, growth stocks will remain under intense pressure.
Which leaves you with one final, provocative thought to chew on as you review your portfolio tonight. We know that the massive physical infrastructure build-out required for AI, the concrete, the copper, the immense electrical draw, is currently causing the very inflation the Federal Reserve is trying to fight. So at what exact point does the technology actually mature enough to finally deliver the deflationary utopia that tech leaders have been promising us? Because until it crosses that threshold, we are paying for the future with the inflation of today. That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.